So we're going to do the slideshow from the beginning.
Perfect.
All right.
All there.
Okay, so quick outline. Again, this is going to be a real short talk, but I'll give you a quick outline of what we're going to talk about. Some basic limited liability company basics and terminology, just so you know what the terms are that people are using. And then just generally, what does an operating agreement address? You know, what kind of issues does it address? Who's it between? What are some of the important things you need to think about when you're ready to start putting together your operating agreement? And so this is just a basic high-level overview of those issues. So some basics in technology. A limited liability company, you'll probably hear people refer to it as an LLC, is a type of business entity that shields its owners from personal liability for the debts and obligations of the business. Now, I'm sure most of you have heard this before, but if you're running a business, it's best not to do it as a sole proprietorship. It's best to form some kind of entity to hold your business so that if there's a problem with the business, your personal assets are not at risk, only the assets of the business. Now, there's other kinds of business entities. Traditionally, most people formed entities as either corporations or partnerships. And the LLCs have really only been around for about 30 years. But they've gotten to the point where they're now by far the most commonly formed type of entity. It's got generally good tax treatment for its owners. It's simple. That in Arizona, you don't have to file annual reports. It's just, you can do just about anything you want to, set it up any way you want to in your operating agreement. So it's very flexible, and it's very user-friendly. So most people now form their companies as LLCs. Owners of LLC interests are called members. Now, you remember for a corporation, if you own equity interest in a corporation, you're called a shareholder and you own shares. If you're an owner of an LLC, you're a member of the LLC and you have what's called a membership interest. Sometimes it's called a percentage interest. Sometimes these interests are called units. It just depends on how the LLC is set up. But the basic terminology is that you're a member if you own an interest in an LLC. LLCs can be either member managed or manager managed. The default is that you're member managed. If you form an LLC, you're the member, you're the sole member, say, you're the one who has control of the management decisions. But you can also set up the LLC so it's manager managed. And the manager can be a member, could be affiliated with a member, could be somebody who isn't even a member. You could have multiple managers, like a board of manager makes decisions. But at the very beginning, when you form your LLC, you make a decision about whether you're going to be member managed or manager managed. And you can change that over time. I just filed something the other day for a client that changed the LLC from being member managed to manager managed because he's now going to take on a whole bunch of new members, and he doesn't want to deal with those people being part of the management structure. So we set it up. We changed it from his company from member managed to manager managed. To form your LLC, you file a simple document. I'll call it the charter, with the appropriate agency in the state of formation. So if you're in Arizona and you want to form an Arizona LLC, you file what are called articles of organization with the Arizona Corporation Commission. If you want to form as a Delaware LLC, you file what's called a certificate of formation. That's the name of the charter, with the Delaware Secretary of State. And this simple document, it's usually a one-pager. It basically says, here's the name of the company. Here's who's going to serve as the statutory agent in case there's the company is getting sued. This is the person designated to receive the complaint. In some states, you have to disclose who the members are, or some of the members, and who the manager or managers are. But that's really about it. It doesn't really get into a lot of the nuts and bolts about how the company is structured, how it operates, how decisions are made. And that's really what you need an operating agreement for. So an operating agreement is an agreement among the members of an LLC. So if you have 3 people who own an LLC, those are going to be the parties to the operating agreement. Operating agreements are sometimes also called limited liability company agreements, or LLC agreements. Arizona LLCs have what are called operating agreements. In Delaware, they're referred to as LLC agreements. It's not that important, but just so you know the terminology, if you hear one, you know it means the same thing as the other. Now, interestingly, you can have an operating agreement even if you only have a single member. And you might want to say, why? I mean, why do I need an operating agreement if it's just me and I don't have to worry about who makes all the decisions because I'm the only member? Well, one reason you may need an operating agreement, even if you're a single member LLC, is that banks often like to see something that makes it clear who has authority to sign documents, sign on accounts, open bank accounts, and that can be specified in a single member LLC agreement. I have a form I use for clients who want to do a single member LLC agreement. It's about 5 or 6 pages. Pretty simple. Now, another thing to remember is, like, unlike the charter document, your operating agreement is not filed with the state agency, and it's generally unavailable to the public. It's a private agreement among the members of the LLC. The state doesn't publish it. You don't have to give it to anybody who you're not required to give it to. It's a private agreement. Okay, let's go to part 2. What issues does an operating agreement typically address? And there's a lot of key decisions that need to get made during the term of a limited liability company's existence. And a few examples here: admitting new members. If you have 3 members, what kind of consents are needed? Does everybody have to agree before a new member is added? Sales of additional equity interest, that's related. If you want to add a new member and you want to raise money and you want to bring somebody in, how much you sell that additional equity for is a key decision that gets made. At some point, there's an exit. Most people form their company with the idea that at the end of the day, they're going to get bought out, and that's going to be their big payday. And one of the issues you want to think about is, when is the when this issue comes up, how does that issue get decided if you have multiple members and or multiple managers? Dissolution of the company. Let's say things aren't going well. You want to sell the assets, pack up your bags, and everybody goes home. How does that work? And when does that work? Who needs to decide when the company gets dissolved? Incurring debt. Maybe some people in the company think it's a good idea to go get a bank loan to expand the business. Others don't. You want an operating agreement to set out what kind of approvals and consents and votes are needed before the company incurs debt. You might be in a situation where the company's going along and somebody says, we need all the members to put in additional capital, additional cash into the company so we can go buy a piece of capital equipment or expand the business in some way. What kind of consents are needed to raise additional capital contributions? And what happens if somebody's required to make an additional capital contribution and doesn't? What happens to them? What are the remedies for the other members in the company? This is just a small sample of the kinds of decisions you may need to make, or the members of an LLC may need to make in the course of the company's term. So one of the things an operating agreement will typically address is, how do these key decisions get made? Who makes the decisions? Is it the members, or if it's a member or if it's a manager-managed LLC, do the managers make the decisions? If there's a manager, what decisions does the manager make and what requires member approval? Usually the manager has authority. If it's a manager-managed LLC, the manager has authority to make the day-to-day decisions about the company's business. But more high-level decisions like selling the company usually requires also member approval, at least a majority in interest, 51%. Sometimes you can require, supermajority approval or even unanimous approval of the members. Another question is, if there's a manager or board of managers, who appoints and removes and replaces the manager or managers? Usually the members do. Sometimes you have multiple members. each one of whom has the right to appoint a manager, and they have the right to remove and replace that manager, but not the other manager or managers. So that's something you want to think about when you're thinking about the management structure of the company. And we just talked about a second ago, do certain decisions require a supermajority vote or even unanimous vote? It's often supermajority or unanimity requirements are good because they prevent somebody from with a bare majority of the ownership interest from making a decision that benefits that maybe the minority doesn't agree with. But if you require a supermajority or unanimous vote, it can be very difficult to get that sometimes if you have a number of members. So that's something you want to think about when you're setting up your LLC. Who's going to have authority to make what decisions, and what level of approvals do you need in order to make those decisions? And then what happens if the members are deadlocked on a decision? I've seen a number of situations where it's a two-person LLC, it's 50-50, and they're just at odds. They can't move forward with the company. They're deadlocked on every decision. They want to take the company in different directions. How do you deal with that situation? And there's one way I'll talk about in just a minute, that a lot of people can save themselves a lot of grief by having an operating agreement that addresses that decision. Other issues that you need to think about. Are members allowed to transfer their membership interest? Think about this. If it's you and one other person who are the two members of the LLC, do you want the other person transferring his or her membership interest to somebody you don't even know? And now you're in bed in this company with somebody that you don't know. This person may disagree with you on a lot of things. So there's often restrictions on the ability of members to transfer their membership interest. There's usually certain types of transfers that are permitted, like transfer it to a trust. You can transfer your interest to a trust that's set up for the benefit of your family or yourself. Other kinds of permitted transfers, you might form an LLC and transfer your membership interest to your LLC for liability protection reasons. Sometimes you'll see a right of first refusal, which is basically going back to the two-member situation. If I want to sell, let's say Anita and I are the two members of an LLC. If I want to sell my membership interest and Anita has a right of first refusal, that means I got to come to Anita first and say, listen, I want to transfer my membership interest to this other person here for this amount. And Anita has the right then to say, no, I'll buy it for that amount, rather than let you sell to somebody else. So that's a way Anita can protect herself against a situation in which she now has a new partner or new co-member of the LLC that she doesn't know and isn't comfortable with. Sometimes a company is given, under certain circumstances, a right to repurchase a member's interest. Let's say one of the members is going bankrupt, and in a bankruptcy, there's a concern that the personal property, including the membership interest that person has, can get assigned or sold to somebody else. And now you have this new member that used to be a creditor or some person off the street you never heard of before. In that situation, for example, you may want the company to have a right to repurchase that member's interest. He or she will get paid for the interest, but now you don't have to worry about in whose hands the interest ends up. Sometimes you'll see things that are called drag along or tag along rights. And this comes up a lot when there is a majority owner and one or more minority owners. Let's say Anita and I have an LLC, and Anita owns an 80% interest in the LLC, and I have a 20% interest. A drag along right in that case would be a right for Anita to say, listen, I've got a buyer out there who wants to buy my interest, but the buyer doesn't want to come in and just be an 80% member. The buyer wants everything. Since I'm the 80% member, I get to drag you along. You still get paid for your interest. You get 20% of the sale price, but you can't hold out and prevent me from selling my interest and the rest of the interest in the company. And a tag along right would be a right I would have to say, hey, Anita, you're selling your 80% interest to somebody else. I don't want to be stuck here with a new 80% majority owner. I'm going to require you, I'm going to exercise my tag along right and require you to include me in the sale. So each of us gets, we get 80% in your case and 20% in my case of the total purchase price. And you have to require this person to buy everything or not do the deal. So this is where you can see it. Probably it can often get very complicated in terms of how these rights that protect, in some cases, the majority owner, in some cases, the minority owner, how these rights end up working. Another thing the operating agreement will address is how do the economics work? For example, we talk about what's called a distribution waterfall. Now, in most cases, when there's money to be paid out, either from operations or as a result of a sale, the money just gets paid out pro rata to the members. But you might have a situation in which one member, it's a 50-50 deal, but one member's put up 80% of the capital. So you may want to have a distribution waterfall that says, okay, everybody gets their capital back first before the distributions start getting paid 20-20. It may go 80-20 until all the capital has been repaid, and then 50-50 afterwards. And you get into some really complicated distribution waterfalls in some of these deals, but that's something you want to address if it's going to be anything different than just simple pro rata. Timing of distributions. One thing that happens with an LLC typically is that the profits and losses that the LLC experiences get passed along to the members, and there's a number of rules that determine how those get passed around. Now, you might have profits that get allocated to you as income to you personally, but if there's no distributions of cash that go along with it, you're in a bad position because now you've got extra income and you don't have any cash to make the payment. So sometimes there are provisions in operating agreements that require the company at least to make an amount, distribute amounts sufficient to allow the members to pay their taxes. Sometimes you can have profits, but the company will want to retain some of those profits to buy new capital equipment, reinvest in the business, and not all the profits get distributed out to the members. So if that's a possibility, you want to address that in the operating agreement. You can also have in the operating agreement something called an anti-dilution provision that gives each member a right. If, for example, the company wants to go out and sell additional equity, everybody has a right, if you have an anti-dilution provision, to buy their own pro rata share of that additional equity so they don't get diluted. If you own a 20% interest and you have 20 units out of a total of 100 and the company is going to sell 100 more units, you may want to have the right to buy 20 of those units to keep your 20% equity interest intact. Another key issue is how are disputes resolved? There's always a possibility for disputes in an LLC. And there's a number of ways you can address those. Often I like to include what's called a mediation provision that says before somebody goes running off to court or to an arbitrator, they have to engage in non-binding mediation where you have a third party that comes in there and tries to help the party work through the dispute. Sometimes you have an arbitration provision. Instead of going to court, people prefer sometimes to engage in arbitration to resolve disputes. Sometimes you have what's called a shotgun buy-sell provision. And this works pretty well, especially when you have a two-person 50-50 LLC. And the way this works is either party, when you get to a deadlock, either party has the right to make an offer to buy the other person's interest. In that case, the other person's interest, you make an offer. I will buy your interest for $5,000, and the other person then has the choice, okay, I can either sell my interest to the offering member, or I can sell my interest, or I can buy his interest for $5,000, the same price. So that gives you an incentive not to set the price too high if you're the offering member, in which case the other person will certainly sell, Or you don't want to make the offer too low, or then the other person will buy you out for that amount. It's kind of like when we were kids and there's one piece of cake and your mom gives you a knife and says, you cut it, and your brother or sister will get to pick which piece they want. You're going to cut it right down the middle to make sure that you don't get less than what's coming to you either way. You can also have a provision that says that calls for an appraiser, for example, a third party to come in and value the company and the equity in the company, and give either party a right to sell back to the company or buy out the other party or parties at that right. So a lot of times disputes ultimately get resolved by one person selling out to another party to the dispute, and then you don't have the dispute anymore.